Dividend and Growth ETF combo build a passive income machine with SCHD and SCHG. Have you ever wished you could have the best of both worlds? A portfolio that grows fast and pays you steady, reliable income? What if you could start with just $10,000, let it grow like crazy, and then watch it transform into more than $7,800 per month in passive income? Sounds too good to be true, right? Well, it's not. This strategy makes it possible, and we're about to show you how. In this video, we're breaking down the ultimate investing strategy by combining two of the most powerful ETFs, SCHD and SCHG. We'll show you how to structure your portfolio, when to shift between growth and dividends, and exactly how a single $10,000 investment can grow into a life-changing $7,800 per month in passive income. By the end, you will have a clear step-by-step strategy that turns your investments into a money-making machine. Let's get started. The best strategy for dividend and growth. Most people think they have to choose between dividend and growth investing, as if they're on opposite ends of the spectrum. But what if you didn't have to pick just one? If you're listening to this, you might remember our deep dive into this topic in a previous video. Consider this a quick refresher, and if you haven't watched that one yet, go check it out for the full breakdown. The best strategy isn't about choosing one over the other, it's about knowing when to emphasize each. When you're younger, your priority should be growing your portfolio as much as possible, and that's where growth ETFs like SCHG come in. They give your investments the power to compound aggressively over time. But as you get closer to retirement, the focus should shift. That's when dividend ETFs like SCHD take center stage, providing a steady, reliable income stream so you don't have to sell shares when you need cash. With this approach, you're getting the best of both worlds. You maximize your wealth-building potential early on, then transition into a stable income stream when you need it. Now, let's break down exactly how to put this strategy into action. First, we need to kick things off with some serious growth. So let's start by supercharging our investments with the ultimate growth engine. Let's dive into SCHG. SCHG, the Schwab US Large Cap Growth ETF, is all about tapping into the power of high-growth companies. Unlike dividend-focused funds, this ETF prioritizes companies that are reinvesting earnings back into their business, fueling expansion, innovation, and long-term stock appreciation. For its strategy, it tracks the Dow Jones US Large Cap Growth Total Stock Market Index, making it a go-to choice for investors who want exposure to the biggest names in tech, e-commerce, and other fast-growing industries. And with an expense ratio of just 0.04%, it's one of the most cost-effective ways to invest in growth stocks. Looking at its holdings, SCHG is stacked with some of the most dominant companies in the market. Apple takes the top spot, making up over 12% of the fund, followed by Microsoft at 11%. Nvidia, the leader in AI and GPUs, holds a 10% allocation, while Amazon comes in at 6%. This no doubt reflects its massive presence in both e-commerce and cloud computing. Meta Platforms, formerly Facebook, rounds out the top 5 with a 4.2% weighting. These are the companies shaping the future, and SCHG gives investors direct exposure to their growth potential. The fund leans heavily into technology, which makes up nearly half of the portfolio, and that's no surprise, given how much of the world runs on software, AI, and cloud services. Communication services also hold a significant share, driven by companies like Meta and Alphabet. Consumer cyclical stocks, including Amazon and Tesla, equally play a key role in capturing changing consumer trends, while healthcare stocks provide a strong foundation, given the constant demand for medical innovation. This diversified mix ensures SCHG isn't just a tech bet, it's a well-rounded collection of the biggest names driving the economy forward. When it comes to performance, SCHG has delivered in a big way. It's not a high-yield dividend payer, with a yield of just 0.48%. But that's not the goal here. The real story is in its growth, with dividends increasing at an annual rate of 14.08%, and the share price climbing an impressive 18.9% per year historically. For investors looking to supercharge their portfolio's long-term returns, SCHG is a powerhouse that continues to reward those who stay invested. So we've got SCHG working to supercharge our portfolio growth. But what about steady income and consistent dividend growth? That's where things get really interesting, and our next ETF takes center stage. Let's check it out. SCHD. Now, SCHD isn't just another dividend ETF. It's one of the best when it comes to balancing strong yield, dividend growth, and solid long-term returns. For one, it focuses on high-quality companies with a history of paying and growing their dividends. What this means is that you get a mix of reliable income and capital appreciation. Unlike some dividend ETFs that chase high yields at the expense of performance, SCHD is designed to give you both. Looking at its top holdings, you'll see a lineup of industry leaders that generate strong cash flow and have a history of returning capital to shareholders. Lockheed Martin, a defense giant, is a stable force in government contracts. AbbVie provides steady growth through pharmaceuticals, while BlackRock dominates the asset management industry. Coca-Cola and Home Depot bring consumer stability, and companies like Texas Instruments and Cisco represent the tech sector while still delivering dividends. This mix of blue-chip stocks ensures SCHD isn't just about yield, it's about sustainability and growth. Sector-wise, SCHD is well-diversified but leans into financials, industrials, and technology. Financials make up the largest slice, with nearly 20% exposure, followed by industrials and tech, each at around 15%. It also has strong representation in consumer defense, healthcare, and energy, ensuring a balance between growth potential and recession-resistant stability. The fund avoids high-risk sectors like real estate, keeping its focus on proven, profitable businesses. Something to note? This isn't just a boring collection of old-school dividend stocks. There's a healthy mix of defensive and growth-oriented sectors, which makes it a well-rounded portfolio anchor. And the numbers back it up. With a 3.79% dividend yield, a historical dividend growth rate of 12.21% per year, and an impressive 13.5% annualized return on its share price, SCHD has delivered both income and growth for investors. It really is no surprise why so many long-term investors swear by it. SCHG has done its job, driving massive growth and taking our portfolio to the next level. But now, it's time to lock in that success with SCHD, turning all that growth into a steady stream of income. So what happens when we combine the power of both? Let's break it all down and see how shifting between SCHD and SCHG over time can turn a simple $10,000 investment into a lifetime of wealth and passive income. Building the perfect portfolio isn't just about picking great ETFs. It's about knowing when to shift your focus between growth and income. And that's exactly what we're doing with this strategy, using SCHD and SCHG to maximize returns while ensuring long-term financial security. We're starting with a $10,000 investment and adjusting the balance between SCHD and SCHG over time to match our financial needs. In the first 10 years, we go aggressive, 80% into SCHG and just 20% into SCHD. The goal here is simple: let growth take the lead. SCHG's high-powered stocks fuel portfolio expansion, while SCHD provides a small but steady stream of dividends. At the end of year one, the portfolio is already up to $11,900, and while dividend income is modest at just $115 per year, the real value is in capital appreciation. Fast forward 5 years, and the portfolio has more than doubled to nearly $24,000. By year 10, we hit $57,000, and dividends reach $600 per year. You can see that the portfolio's value is growing rapidly, but dividends are still relatively low, and that's okay. This stage is all about maximizing growth while we still have time. At the 10-year mark, we shift to a 50-50 split between SCHD and SCHG. We lock in some of those SCHG gains and transfer them into SCHD, increasing our dividend payouts while keeping a strong growth component. By year 20, the portfolio has skyrocketed to $328,000. But here's where it gets really exciting. The yearly dividend income has jumped to over $8,300, which means you're now pulling in around $700 every single month. That's real usable cash, enough to start covering bills or even fund some serious lifestyle upgrades. And the best part? It's not just from portfolio growth in SCHG. The compounding effect kicks into high gear because SCHD's higher dividend yield is now fueling even more reinvested dividends. So instead of just relying on stock price appreciation, your money is working double time, growing in value while also throwing off bigger and bigger payouts. After 20 years, we shifted again, this time leaning heavily into SCHD with an 80-20 split. This is the transition into a more income-focused strategy, ensuring stable cash flow while still keeping some exposure to growth. And by year 30, the results are staggering. The portfolio sits at nearly $2 million, and monthly dividends have skyrocketed to $7,800. That's $93,000 per year. This is the power of compounding, smart allocation shifts, and strategic investing. Of course, this allocation isn't one size fits all. If you have a steady income from a job or side hustles, you might want to stay more aggressive with SCHG for longer. On the other hand, if early retirement is your goal, shifting into SCHD sooner could give you the income stability you need. It all depends on your financial situation and goals. But no matter how you adjust it, this strategy proves that balancing growth and dividends over time is one of the most effective ways to build wealth and secure financial freedom. That's it, a powerful strategy that balances growth and dividends. By starting with SCHG for aggressive growth and gradually shifting into SCHD for steady income, you create a portfolio that not only builds wealth, but also pays you to enjoy it. Just remember, investing is a journey, and the key is to stay consistent, reinvest, and let compounding do the heavy lifting. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.